Well, at the beginning of 2026, the outlook was definitely one of cautious resilience. And at the mid-year, I think it's quite clear that global growth forecast hasn't really changed dramatically, but for mid-market and mid-corporate businesses, the operating environment definitely has. Um, In January, the outlook assumed that inflation would continue to ease, interest rates would gradually come down, commodity prices would soften, and businesses would continue adapting to the trade disruptions. But what we see from the latest outlook, if we look at the World Bank, IMF, and also S&P, by June, the risk has really shifted towards higher energy prices, commodity costs, renewed inflationary pressures, and potentially higher interest rates for much longer, and of course, much more complicated supply chains. So this change is not simply that global growth has moved from 2.6 to revised down to 2.5%. The change is really the conditions under which that growth has to be achieved. And I think that matters particularly for your mid-market. Um, Large corporates generally have diversified revenue, treasury teams, broader access to capital markets, formal hedging programs, and more bargaining power with suppliers and customers, where smaller businesses may have less organizational complexity and in some cases can retreat very quickly to a narrower operating model where your mid corporates often sit in this difficult space between the two. They have much of the complexity of large companies, so multiple customers, employees, various sites, multiple jurisdictions, and funding requirements, but not always the same financial buffers, management depths, and systems or access to capital. And again, they may be well established businesses with strong customer relationships and good market position, but they may also rely on one or two banks, relatively small management team, a few important customers, key suppliers, and founders or family that still carry much of the institutional knowledge. And this means that the macroeconomic change that we've seen between January and June can really become an operational and financial issue very, very quickly. A large company may absorb higher energy costs for a period where a mid-market business may see those costs more directly through its margins in its working capital and impacting its banking facilities. A multinational might hedge its currency exposure, mid-corporate importer may have to manage that volatility through pricing, inventory, supplier terms, and timing purposes, depending on what access to products it has. And that is why I think the mid-year outlook should not simply be treated as a economic or economist update, but it should lead to a management response. Now, if we briefly consider what has changed since January, one of the clearest changes in seen is the energy and commodity outlook. In January, commodity prices were expected to decline. Brent crude was forecast to reduce to an average of about $60 a barrel. But of course, we now know by June that this forecast has shifted towards a meaningful rise in commodity prices. Brent now averaging closer to 100, and fertilizer prices also increasing sharply. For mid-market businesses, the effect extends well beyond the price of fuel. It really becomes and is seen through transport, electricity, packaging, agricultural inputs, manufacturing, cost of refrigeration, distribution, and ultimately customer affordability. It can also then produce a double squeeze because costs increasing, but the customer may be less able to absorb the price increases because household and corporate budgets are already under pressure. And this puts much greater pressure and much greater importance on this understanding profitability at a much more granular level. So not simply whether the business is profitable, but which customers, which product, which contracts, which routes, what channels are still creating value after the logistics, the working capital and finance costs pressures are taken into account. So a company can show revenue growth, but it can still actually become financially weaker. In an inflationary environment, nominal revenue may increase while volumes decline, margins narrow, and more cash becomes trapped in inventory and receivables. And leaders therefore need to be very clear on distinguishing between revenue growth, profitable growth, and what is cash generative growth. And those are not the same thing. I think the second key change is the financing environment. In January, many companies were anticipating a gradual easing in interest rates and improved financial conditions. By June, the outlook is less certain. There's renewed energy and food inflation that may delay some monetary easing. Sovereign debt pressures can also feed into bank funding costs, government yields, and currency risk. Your mid-market companies are particularly exposed because they often fund themselves through bank debt, overdrafts, revolving credits, asset finance, and of course shareholder capital. And they usually do not have easy access to listed debt or broad institutional capital markets. Now, of course, within your mid-market or mid-corporate space, accessing those markets become a huge competitive advantage. The World Bank, in their latest report, highlight that access to finance remains a significant obstacle for firms in emerging markets. And that mismatch between long-term investment needs and the short-term nature of available banking finance is much greater than in some of the advanced economies. And this is an important warning. A business should not fund a long-term asset with a facility that can be withdrawn or repriced at short notice, and should not wait until a covenant is under pressure before speaking to its lenders. So this time to engage with banks, investors, and shareholders is while the company still has options. The third shift is that the outlook for your emerging markets and Africa has deteriorated by more than the headline growth numbers suggest. The forecast for sub-Saharan Africa has been revised down, while South Africa expected to grow for 2026 has moved approximately from 1.4% to around 1%, which means South African mid-corporates should not build their plans around broad domestic demand recovery. Some sectors will perform better than others, sure, but for many businesses, growth will have to come and be earned through market share growth, through innovation, regional expansion, acquisitions, new channels, and higher productivity. Simply waiting for the economy to lift the business is unlikely to be a sufficient strategy. I think in many cases, not something new for many emerging markets. In looking at all of this or reacting to all of this, I think generally speaking, the first practical response, taking this into account, is to rebase your plan. I would caution against simply taking the January budget and reducing revenue by, say, 5%. That would produce a revised spreadsheet, but it doesn't necessarily produce a revised strategy. And management should revisit the assumptions beneath that plan. What exchange rates were assumed, what oil price, what transport, electricity costs were assumed, what interest rate path was assumed, how quickly were customers expected to pay, what level of inventory was considered normal, how dependent is the business on one supplier, one route, one customer, one funder, and what happens if several of these assumptions move in the wrong direction at the same time. And mid-market companies should really develop a small number of practical scenarios, not 20 economic scenarios, but perhaps 3 operating scenarios that management can actually use. A base, a prolonged cost and energy pressure case, and a combined demand, currency, and financial stress. And each scenario should be linked to agreed actions. And I think that's the important point. You do scenarios and you do scenario planning to act in the now. And so it has to link to actions. So at what point do we reprice? At what point do we change our purchasing patterns? When do we defer capital expenditure? When do we activate an alternative supplier? When do we approach shareholders or lenders? When do we reduce dividends? And when do we stop trying to protect a product, customer, or market that is no longer creating economic value? So scenario planning really becomes useful when it changes behavior before the crisis really arrives. I think a second action to consider is related to working capital. For mid-corporate businesses, I think first sign of stress is often not an accounting loss, but it's seen in the working capital. Inventory costs are more, customers pay more slowly, suppliers shorten terms, banks become more cautious, and suddenly a profitable business runs short of liquidity. So I think a rolling 13-week cash flow forecast, if it's already not there, become a very active management tool, not something produced only when the company is under pressure. And management to stress test the effect of slower customer payments, higher inventory holdings, and weaker currency and higher interest rates, and the loss of potentially a loss of one customer. The business should also understand the working capital's cost of growth. So a new contract may look attractive on a EBITDA basis, but if the company must purchase stock up front and wait 90 to 120 days for payment, that growth may consume much more cash than the company can actually afford. And in the current environment, cash conversion should sit alongside revenue and EBITDA as a primary measure of performance. So sales team should not be rewarded only for signing contracts, but procurement should not be awarded only for achieving the lowest unit price. Operations should not maximize production while inventory accumulates. Each function must understand the effect of decisions on the entire cash flow. Another response is to preserve your optionality, specifically your financial optionality. And this means maintaining covenant headroom, reviewing debt maturities, matching debt to the currency of earnings, and reducing unnecessary dependence on short-term facilities. It may also then mean broadening your funding mix. So for some businesses, that could include private debt, development finance, asset-backed facilities, maybe alternative funders, strategic investors, or blended finance structures. But the answer is not simply to add more debt. Leverage should be used to support productive investment and growth, not to disguise weak cash generation or fund distributions that the business cannot sustainably afford. At the same time, companies should obviously avoid a blanket freeze on investments. We saw this from the World Bank's June report, makes a strong case for private investment, noting that private investment growth in emerging and developing economies has slowed materially and that firms continue to face constraints related to infrastructure, uncertainty, and access to finance. So for mid-corporates, the question really should be which investments improve our resilience, our productivity, and long-term competitiveness across more than one scenario. Again, why scenario planning becomes so important. So I would divide capital allocation into sort of three broad categories: defend the core, adapt the operating model, and then the future build. And depending on really defend the core means protecting the liquidity, the critical assets, key customers, and essential talent. Um, Adapting the operating model means investing in energy efficiency, supply chain visibility, process automation, data quality, cybersecurity, working capital management. Build build for the future means continuing to invest in selectively in new markets, new products, capabilities, and acquisition that strengthen the company beyond the current cycle. The danger is is either extreme. So continue to invest as though nothing has changed is likely irresponsible. But cutting every investment and retreating into survival mode can leave the business strategically much weaker when conditions eventually do improve. I noted briefly about revisiting the business model, and I think what we see from the mid-year outlook, and this should also prompt a much more fundamental business model discussion. But how dependent is the company on transactional revenue? Could more value be created through re-looking at the business model, recurring contracts, subscription service agreements, maintenance agreements, aftermarket support, longer customer relationships? And how much pricing power does the company really have? Can contracts include sensible inflation, fuel, currency, and commodity adjustment mechanisms? Can the product design be simplified? Can the company reduce the number of low volume, low margin offerings that create operational complexity without generating sufficient returns? Can parts of the cost base be more variable? Again, adding to that optionality. Where does the company need greater control rather than outsourcing? And again, the answer is not always to become asset light. A company may need to own or control critical energy assets, customer data, intellectual property, distribution capabilities, or key parts are in the supply chain. So resilience is not about um, outsourcing everything either. It's about knowing which capabilities cannot be allowed to fail. And energy might be a good example. So, for many mid corporate businesses, solar generation, storage, efficiency, and more flexible energy production and procurement should no longer be treated only really as a sustainability initiatives. They've really become part of the operating model and business continuity decision. And we see this from the report as well. It really identifies energy security as a urgent priority and highlights the value of energy diversification, efficiency, and decentralized renewable solutions. Looking at all of this, I think trade has remained much more resilient than might have been expected, but it's also being reconfigured. So for mid corporates, that creates, I think, an important opportunity, specifically for those on the African continent. Regional trade, the Africa Continental Free Trade area, changing supply chains and the search for alternative suppliers can open markets for companies able to deliver reliable products, logistics, manufacturing, food, energy, and business services uh, across borders. But again, regional expansion should be disciplined. Entering five new countries is not automatically diversification if all five introduce new currency, new regulations, new working capital risk. So the question is whether the company has the repeatable business model, the right local partners, appropriate funding, and sufficient management capability and capacity. So the regional growth should really reduce concentration without creating uncontrolled complexity. And I think this always brings us to leadership, and leadership really matters in your mid market. Many successful mid market businesses have been built through entrepreneurial energy, customer intimacy, and personal judgment of founders, family, and small executive teams, and those strengthen those strengths should not be lost. But what helps a business reach a certain scale can eventually prevent it from moving beyond that scale. So the founder's ability to make very important decisions may initially create speed, but eventually it can become the organization's primary bottleneck. So businesses say it wants to grow regionally, adopt AI, acquire competitors, or bring external capital. But if decision rights remain unclear, financial risk and financial information is weak, management depth is limited, and every decision still returns to one person, the organization is not aligned with its strategy. So strategic alignment work is definitely useful here. We need to see purpose translated into clear strategic choices, and those choices must then be supported by the right structure, capabilities, processes, culture, governance, metrics, and ultimately incentives. And we know that alignment's not about whether each of these elements exist individually, but how they reinforce one another. So the company cannot claim that cash generation is a priority while rewarding management only on revenue growth. It cannot say that customer diversification is essential while allowing one sales executive to protect um, uh, unit economics concentration. It cannot say that regional expansion is strategic while refusing to develop the managers capable of running the new markets. It cannot say that succession matters while keeping all the institutional knowledge inside the founder's head. So governance should therefore be much more deliberate. It doesn't mean that it doesn't mean importing large corporate bureaucratic systems into a mid-sized company, but it means establishing proportionate governance, a capable board or advisory board, clear decision rights, better management information, succession planning, risk oversight, and a regular strategic operating rhythm. So the objective is to preserve the entrepreneurial speed while reducing dependency on any individual heroics. Now, as I start wrapping up, I want to look at a few perspectives around um, not just from what companies should do, but also what investors should be thinking of. So I think firstly for private equity, for family offices, for banks, for strategic investors, the mid-market remains very attractive, precisely because it contains many businesses with strong positions that have not yet reached their full institutional potential, but underwriting need underwriting these needs is becoming demanding. Investors should, of course, then look beyond reported EBITDA. How much EBITDA is actually converted into cash? How much cash flow is needed to support that growth? What maintenance capital expenditure is genuinely required? How concentrated are customer suppliers management relationships? How much of margin depends on favorable currency or commodity conditions? Is debt matched to the company's earnings? Can the business operate efficiently without the founder making every decision? Leverage should be conservative enough to allow the company continue to invest through volatility. Value creation should rely less on multiple expansion and more on operational improvements, um, professionalization, productivity, market expansion, and strategic acquisitions. Exit assumptions should remain realistic. Mid-market businesses may require longer holding periods, and the eventual exit route, whether it's a strategic buyer, another investor management, or family successors, or the public market, should be considered early rather than at the end. So, for families and owner-managed businesses, this environment is also a reminder that ownership strategy and business strategy are definitely connected. Does the family want to retain control? Is external capital required? Is there a credible next generation? Would a minority investor, strategic partner, or practical or partial sale create greater resilience? And these discussions are easier when they happen before the company needs capital urgently. So for a mid-corporate business, I think over the next few months, I would suggest mid-corporate boards and leaders do several things. I think firstly, revisit the assumptions underlying the earlier budget, put in place an active 30 or 3 month, 6 month cash flow and covenant forecast, analyze margins and cash generation by customer, product, and channel. Stress test your top customers, suppliers, lenders, currency, and key person exposure. Divide your investments into defend, adapt, and build. Conduct a very focused alignment review across your strategy, your structure, your capabilities, your governance, your metrics, your measurement, and then also incentives. And speak early to lenders, to shareholders, and other potential capital providers about future requirement and options. The earlier the year message was that resilient businesses could continue to grow through uncertainty. And I think the June message is much more specific. Growth is still possible, but it must be financed, it must be operationally executable and aligned with the organization's real capabilities. So your mid-market business will not win because they have the deepest balance sheet or the largest team, but they'll succeed because they can see changes early, remain close to customers, make decisions faster, and adapt their operating model much more deliberately. But agility without governance becomes improvisation. Growth without cash becomes fragility. Resilience without investment becomes stagnation. And strategy without alignment remains aspiration. So the real opportunity for your mid-market is therefore to combine its entrepreneurial strength with much greater financial discipline, management depth, and institutional capability. And this is how good mid-sized businesses becomes an enduring enterprise. I hope you enjoyed the session, and I will also share a more generic commentary, not just focused on mid-market, in a separate video. But hopefully you enjoyed the brief review of where growth currently stands or the outlook currently stands, a few suggestions on what to consider from an opportunity and risk point of view, and also a brief view on a 90-day day plan. We'll talk soon.